What's going on, everyone? It's Julien Meyer, Managing Director at NorthStar Venture Partners, and today I'm going to be chatting on a topic that a lot of founders ask us about, portfolio companies, advisory clients. Almost every first-time founder asks us to explain to them what the different funding rounds are. And it's a question that's super important, but it's one that it's a little bit vague when it comes to rounds, and that's what we want to start off, or what I want to start off by saying rather, is that the way rounds are named is a little bit, best way to put it, is a little bit confusing. It could have to do with the amount of money you're raising. It could have to do with the amount of experience you have as an entrepreneur. It could have to do with whether it's a priced equity round or whether there's debt involved. So what we're going to do in this video today is we're just going to give you a rough overview of what rounds look like, but just take it with a grain of salt, that what these rounds look like and what these rounds are named can vary based on where you are geographically, can vary based on what stage you're at with your company, and really can vary on a myriad of other factors that your potential investors might actually point you in the direction of naming or pricing around that. So what we're going to do is we're just going to go in a linear fashion from the typical smallest round to the larger rounds, and we're going to get all the way into IPO. And I'll give a little bit of commentary on each round and what it means loosely and roughly within the venture community, and that'll be the video. So to kick things off, most founders, when they start their business, will do what's known as a founder's round. This is also what's known as bootstrapping, and bootstrapping is basically saying, I'm not going to raise any outside money. I'm literally going to work a second job or a third job or whatever, and I'm going to use that money to build my business. Or I'm going to take the money that's in my piggy bank, or I'm going to take the money that I inherited, and I'm going to start this business. And there's certain entrepreneurs that prefer to go that route the entire life of their business, and they're what's known as bootstrapped entrepreneurs. They don't really interface with the venture community. They don't really interface with the investment crowd. They focus on building a good, profitable, solid business, hopefully from day one. So bootstrapping, or founder's round, right, is typically the very first round of a company. And it's not, again, unique to the venture community. It's not unique to the investment crowd. It is simply what you have to do to pay for the licenses to get your business set up, to pay for your tax accountant, to set up your bank account, to get your website. Whatever you need to get the business set up is typically what's referred to as bootstrap money. And we call it, in the venture community, a founder's round. It means that you as the founder, or you as the founders of the company, have put money into this organization through your own pocket. You've taken money out of pocket, you put it into the company. It's the first $1,000 in the company bank account. It's the $500 it costs to get the website set up. And so it's a very simple round, but it's the most important one because it's what starts your business. So that's what's known as a founder's round. It's also what's known as, if you continue to go down that path, bootstrapping a business. Now, typically after a founder's round, what you're going to get into is another F round, okay? It's a friends and family round. And it's comically referred to as a friends, family, and fools round sometimes. Basically what that means, and it's a lighthearted joke, it's that you're going to your friends and your family who trust you, who may not know as much about your business, who may not know about the industry that you're in, who may not know a lot about just overall, business in general, but they trust you and they like you and they want to invest in your business. And so the friends and family round is typically the first round of financing that an entrepreneur will do in order to get them to a larger round of financing where they can bring on more sophisticated investors. Friends and family rounds typically range from, on the low end, like $5,000 invested capital up to maybe $25,000, $50,000, $100,000 if you're lucky, but they really don't tend to get past that unless you come from a very wealthy family or have some other access to capital within your own network, in which case sometimes you don't even have to interface. Once again, this is another round where you're not locked into the venture community yet. You're not locked into continuously raising from the investment crowd, if you will. You're staying in network. Right? You're staying within your family, you're staying within your friends, and so it all depends on how deep your network runs. And one thing to note about a friends and family round, like we said, it ranges from about $5,000 to $100,000. Typically, you're giving up, anywhere from 2% equity to, maybe 10% equity of your company. 20% on the high end, but that's pretty rare. But regardless, one thing to note with a friends and family round is that you can't just hear friends and family and think, okay, it's my immediate family, my immediate friends. You have to go deeper than that if you want to find money successfully for a friends and family round. You have to think of, okay, who does my father's brother know, right? Who does my uncle know? You may want to say to yourself, who does my friend from college have in their family that might know somebody that I can raise some money from. That's still technically a friends and family round. It's using your individual personal network to raise capital for your business. Now, from the friends and family round, we graduate, we move into pretty much what's going to be known as your first official kind of investment round. It's the coming out round for a company. It's the round that basically announces to the world, hey, we're going to be raising capital. We have an idea that's going to scale. And remember, folks, we're oriented to, talking about the technology sector for the most part. So this is a very tech-oriented video. This changes a little bit, especially if you're doing brick and mortar business or real estate business. You're probably not going to have these same types of rounds, but this is very specific and unique to tech. But it's useful information regardless to understand how capital is raised. So the angel round, like I was just saying, is typically the first official or real round of capital that you're going to raise. Angel rounds typically on the low end are going to be around the $100,000 mark, and on the high end they're going to be closer to $1 million, maybe $2 million, or maybe if you're in San Francisco, higher than that. But the fact of the matter is, this is for a lot of startups and for a lot of founders the first round of significant capital that they're bringing to their organization from outside of their own personal network. So the angel round is a big, big step. And the angel round is typically raised from angel groups or from individual angels, high net worth individuals that make investments into your sector, or from an accelerator program that might invest in your vertical, right? So if you are a medical device startup and you get into a medical device accelerator that gives you $100,000 and takes 7% of your company, and an accelerator, what they do is they'll incubate you basically for 3 months, give you free office space, give you access to legal help, give you access to different mentors to protect their investment. That's one way of getting that capital. Another way, like we said, is angel groups. These are groups that meet monthly, bi-monthly, quarterly, once a year, whatever they might meet. You can find them on gus.com or angellist.com, and you basically apply to pitch, and they see, let's say, 30 to 40 pitches when they meet, however often that they meet, and then they'll pick, let's say, 3 or 4 of those pitches or those founders that they're going to invest money into, and it's usually the same amount, 50,000, 100,000, whatever it is. And so, angel groups are super important because they signal to the rest of the investment world, hey, we're legitimate. We have this angel group, especially if it's a well-known angel group or an accelerator, right? Some common names here would be a Y Combinator, Techstars, the New York Angels, San Francisco Angel Group, all these types of groups, all these types of people where if you get an investment from them, it signals to future investors that, hey, we're a safer bet because these people already vetted us and went through our company and they see something that they think is going to be successful. So that's your angel round. From angel, you typically get into the seed round, but the seed round has more recently, been broken down into a pre-seed and a seed round. And a pre-seed is basically exactly what it sounds like. It's the round before you raise a seed round. The seed round traditionally, historically, has been known within the tech community as the round where, okay, now we're making the jump from angel to venture capital. Angel investors are not venture capitalists, right? Some might brand themselves as that, but criteria for angel groups is pretty standard. They meet at a regular time period, or they're a high net worth individual, and they make relatively the same size check investment into companies, and they stick within some kind of vertical or something that they understand. The venture capitalists, these are firms, these are groups whose whole goal is to find companies that they believe are going to scale and are going to 10, 20, 30, 40, 50x return over the lifetime of that investment, right? So their whole model as a venture capitalist is to find high growth companies early on to take a bet on and really, pray and hope that they scale up. The venture model is one in which math plays a huge role, and it's basically a business where they have to be super right 10% of the time, but 90% of the time they can fail, right? These investments can fail, they can go south. That's how these funds are set up mathematically to work. So because of that, what you have to think about when you're getting into this pre-seed seed stage is you have to say, okay, I'm getting involved in an ecosystem that actually expects a roughly 90% failure rate. What does that mean for me? It means you're entering into the arena, right? It means you're playing in the big time show now, right? And this is why the seed and the pre-seed round, as opposed to the angel and everything we've done before, are such crucial rounds. These are rounds that range from, on the low end, let's call it $250,000, on the high end, $2, $3, $4 million. But the dollar amount isn't as important, to be totally honest with you, in a seed round as what it signals to the venture capital community. It says, hey, we did get our angel round, somebody approved us, somebody liked us. We've now graduated, we got a seed round, we have some VCs that came in, we have some professional folks that have invested in this round, and now we're going to be scaling up pretty quickly here. and we're going to be ramping up and getting ready for our next round, which is called a Series A. Right, so the seed, again, it's really this, it's almost this, it's a signal, a sign, it's a real indicator, if you will, to the venture community that you now understand what game you're going to be playing, right? Because the game you're going to be playing now is one of scale. The game you're going to be playing now is one of, you have to be a high growth company. You have to really, you have to pretty much have product market fit after this round, which means you have traction, you know where your customers are coming from, you know who your buyers are, you know who your users are. It's no longer just ideas that you're throwing at a wall and saying, oh, I hope this one sticks. It's actually a fleshed out business model, because in your next round, right, post-seed, when you go for what's known as a Series A, this is the most popular round that you probably read about in any tech publication. A Series A is another kind of inflection point where you go from all the way up until here, you've been raising capital to build the business, right? All the way through seed, you've been raising capital to start it, to build it, to get it going, to get the machine churning. By the time you hit Series A, for the most part, at least in traditional venture capital, not some of the crazy stuff we see today, but in the venture capital model as it's meant to be played, if you will, by the time you get to Series A, you've reached a point where you're using this capital as growth capital or scale capital. This is capital that you're now officially coming in and saying, hey, look, we don't have that much revenue yet, but we have a piece of software, or we have a piece of technology, or a piece of hardware that we now know exactly who our customers are. We know exactly how to market to them. Yes, we may have to make a few little pivots or tweaks here and there, but at least for where we're at in the life cycle of our business, we have an understanding as to how we can make revenue. We have an understanding as to who is buying this thing, and now we need to raise this capital basically to market it, to grow it, and to start selling it. Right, now remember, what I'm talking about here, if you hear me clearly, is I'm not talking about profit here yet, okay? That's the interesting thing about venture and venture capital in general, is you're not necessarily building a business that's focused on profit. It's not focused on returning equity to shareholders in the traditional sense, right? You can think very simply of a company like Uber that publicly stated when they went public through an IPO that they don't have a path to profitability. They don't know how they're going to make money. Right, but they generate a significant amount of top line revenues, and so their whole model is that they'll become so big at some point in such a fabric of society that you're going to have to stick with them, and that they're eventually going to make money. It's basically what was introduced to us by Amazon, right, in the age of the internet. And the thing with that is it's a dangerous game to play, because I think you can see how high the failure rate is in a situation like that. But the fact of the matter is, that's a big part of what venture gambles on. Venture gambles on the fact that they're going to find unicorns. So don't mistake the fact that you're getting a Series A for this huge stamp of approval of saying, oh, you're destined to succeed. A Series A is simply the beginning of the real journey when it comes to the venture model. Now the real hard work comes in, and that you're going to have to grow month over month, year over year, your user base, your scale, the amount of people that are using your product or your software. Because now what you're going to have to do is you're going to have to pretty much stick with the venture route if you want to continue raising capital. And by sticking with the venture route, you have to meet their metrics. They're going to want to see, depending on what your vertical or your industry is, but they're going to want to see growth that's above average. They're going to want to see scale that's abnormal, that's on the high end. They're going to want to see what's traditionally known as hockey stick growth. And if you're not familiar with that term, Google it, because that's a big thing when it comes to raising venture capital money. Right, and so that's kind of the Series A round in a nutshell. It's a super important round for tech companies, because it means that you're at a stage where you have product market fit for the most part, and that you're ready to scale and ramp up. Now, from A, traditionally, right, you would think that what comes after A in the alphabet, B. We'd go to Series B. But between Series A and B, because you're still new, if you will, you're a newbie in the venture world in terms of what you've raised, how much capital you have, and how you interface with the community. The venture community basically wants to flesh you out before Series B. The investors that invest in Series B are not the same investors that invest in Series A. The Series B investors are looking for much less risk than even a Series A investor, even though they're still venture capitalists. So when you're going from a Series A to a Series B round, what ends up happening is we see these companies that might prematurely raise a Series A, and they spend the money and they don't have that scale that they were supposed to have to raise their next round. So you see an A2, right, which could be an extension of a Series A round. Meaning, okay, well, we already raised $3 million on this round, but we know now by spending that $3 million that here's what we actually have to do. We want to raise another $1 million, so they'll either reopen the round or they'll announce a new round. Typically, as a follow-on to that A, and that A2 is going to basically sustain them through or that's the thought process, sustain them through to when they can raise the B round, which is really 100% almost always pure growth cap at that point, okay? So A2 is one name for that. Another name, which is a little bit more popular these days, is a bridge round. Bridge rounds used to be somewhat of a negative term when it came to venture capital. You didn't really want to raise a bridge because it indicated that you might have done something wrong with the A round, but today bridge rounds are becoming more and more popular. They're typically done through some kind of priced equity round. They use a convertible note or a SAFE or something like that. And folks, just so you know, if you're confused about any of these terms, SAFEs, convertible notes, we'll be doing videos on all that stuff. So you're always, more than welcome to pause the video and Google it, but we'll be doing additional videos on all these things. This is just one to give you an idea as to, what the rounds are and what they look like. So again, just to get back on this concept of the bridge, they're typically, like I was saying, done through some kind of a priced equity round, or very rarely, but sometimes done with debt if necessary. And everything here, folks, that we're talking about for the most part is done through what I was just saying, a convertible note, or more popularly as SAFE now, which is it's a form of equity that starts out as debt until it converts. And just look up convertible note or SAFE notes, figure out if that's the best way for you to raise, but that's pretty common in the venture community in terms of when you hear, oh, we're getting a term sheet for a round, you're probably getting a convertible note or a SAFE. So anyway, to kind of wrap up on where we are in the rounds, right? We've gone now through, as a recap, our founders round, right? Our bootstrap round. We've gone through our friends and family round. We've gone through our angel round. We've gone through our pre-seed and our seed. We've gotten through our A, and now we're at our A to our bridge, and we're really trying to figure out how we're going to get to B. All right, and so by the time you get to B, what a Series B investor is typically going to look for, they're going to be much more strict than a Series A investor was, and saying, okay, where are you guys at as a company, and how do we know that when we put this money in, that it's going to lead to additional revenue or to additional growth or whatever it is. They're going to be super strict on saying, where is our money going, how are you spending it, and show us data points that prove, all right, at least roughly prove that this money is going to grow this company. So the Series B investors, that's when you start to get really, really strict, right? And so from B, typically, right, which is growth capital, you're going to go through C, you're going to go through D, and it used to be that you would go through a Series C and a Series D, and then go public. And just to give you an idea on the amounts here, Series Bs, you're typically getting into the $10-20 million range, low end 5 million, but you're roughly in that range of 5 to 20 million. C, you're going 20 all the way up to 100 million. D, you're going 100 to 400 million. And now we've seen these crazy rounds where these companies are staying private longer and longer, where when I first got started in business, these really didn't exist, but we're getting into Series E, F, and G rounds. And the only thing, folks, if you notice how we're naming these rounds, the names at the beginning are pretty important, but as you go from B really all the way through to IPO or private equity exit, which we'll get into in a second, you're just naming the next letter of the alphabet, and it just has to do with how much more money you're bringing on. And the one thing that you'll note is that for the most part, a healthy company is always raising more in that next round. B is more than A, C is more than B, D is more than C, E is more than D, right? You never want to really do a down round, is what it's called, and I'll let you folks Google that, why you don't want to do a down round. But that's basically the logic as to how we name rounds post Series A. It's just B, C, D, E, F, G, and it's typically more and more capital in each round. And again, folks, remember that based on your vertical or your geography or the past investors in your company, those amounts may vary, but these are rough loose amounts as to what typically goes on. And then finally, so once we hit an F or a G round, we get into basically what your two options are, right? You have this acquisition opportunity or private equity exit, kind of similar, not one and the same, but very similar. That's on one side of the table. And these are the companies that they sell to Google, right, for $100 million. They sell to Twitter for $1 billion, whatever. That's an acquisition exit, right? That means that you've sold your company. There's some kind of cash outlay. As a founder, you cash out, boom, everybody's happy. All the investors make money. Or it's a private equity group that, these are groups, financial groups that specialize in buying out certain companies. And so they buy you guys out. You have one parent owner now, and you guys have cash, and they have a business that they can now reap the profits of. The other option you have, and this is really become more public or more prominent, if you will, in the last 5 to 10 years in this bull market that we've been in here in the States, is you have the IPO route, right? And that's kind of the holy grail. That's mecca for a lot of entrepreneurs, is to take their company public through an initial public offering or an IPO. And so when you get to the IPO, what you're doing is you're basically switching from taking on all this private equity, right? Taking on this venture capital money, taking money from investors that are making a bet on you and your company and are in the private sector. And you're opening it up to the general public, right? You're saying, hey, we're going to put our company on the market and anybody can buy shares of stock, which is going to fund our company, right? And so that's pretty much the end of what we need to know as entrepreneurs and founders, because when you're at that level and you're at that scale, the debt packages that you're going to be offered from banks and the other ways that you're going to finance the company, you're getting into corporate debt, you're getting into a whole different understanding of financial markets, and you're going to have such a big team on the financial side that you're not even going to really, you're going to, as the CEO, have to know what's going on, but you're not going to have that expertise. So for us to know what's important as founders is, again, as a summary of the rounds, you're starting with your bootstrapped founders round, right, where you're just putting some money in, a couple $1,000, a couple $100, whatever. You're going to your friends and family round where maybe you're getting $10,000, $25,000, from friends and family to, get this thing off the ground. Then if you're going down the venture path, you get your angel round, right, maybe 100K. Then you go from your angel round into your pre-seed and your seed, maybe get your first $1 million. Then from seed, you go to Series A, right? Hopefully you're not bridging between seed and Series A, but you go to Series A, and typically you're getting between 1 and 5, 1 and 4 million there. And then you go into your A2 or your bridge if you have to. Hopefully you don't. And then you go through B, C, D, E, F, and God willing, if you're lucky, you have an exit. Now, is it common for a lot of startups to get there? No. The fact of the matter is we still have a very, very high failure rate when it comes to startups, especially in the US, right? And so if you get to Series A, right, you're already very lucky, but don't take that as a mistaken sign that it's over, right? That, oh, you've made it. Because there's plenty of companies that we've seen that even get to Series B or Series C, this growth capital, and they finally realize, and even the venture capitalists that were making bets on them say, you know what? This company's never going to work, right? We've been spending way too many marketing dollars to get this thing to where it is now, but it's not sustainable, right? And that happens a lot in the venture community. So don't think that just because you've gotten to a certain round or you've raised a certain amount of money, that that's the end. A financing round is almost always the beginning of a heck of a lot of hard work that you're going to have to make happen if you want to be successful from there. So folks, again, as a recap, this was a video just discussing the rounds that most founders will have to interface with if they're going through any business that they want to get venture capital backing for. It's a loose set of guidelines and rules. Nothing of what we discussed here today is really final in the sense of its information, right? Rounds are ever evolving, right? We've seen mega rounds these days. Like I said before, when I first got started in the business, you really didn't see companies going past Series D, but today we're seeing E, F, and G. So you have to stay up to date on this stuff, and there's a lot of good resources. You can read about this in the Wall Street Journal, on the venture capital pieces that they do. You can read about this on Bloomberg. You can just do a general search. Right, but getting educated on what's going on in the world of financing, if you're a fundraising entrepreneur, is super important, because you want to be as smart as the people sitting across from the table who are going to be your investors. You want to be able to negotiate. You want to be able to know what you're asking for. You want to be able to speak in such a manner that they respect you and say, hey, you know what? These guys know what they're doing. They understand, what they're trying to raise for. They understand roughly what they need to and should be asking for. And so the fact of the matter is, at the end of the day, the reason you want to get educated on this stuff, the reason that you want to understand everything that's going on in the world of financing and rounds, is so that you can raise more capital and give away less equity, and thus protect your business and your shareholders when you have to interface with any of these fundraising rounds. So folks, that's been just a little bit of a crash course on funding rounds for entrepreneurs and specifically for tech founders. If you have any questions, or if you want to work with us, you want some advice on any of this stuff, feel free to send us an email at info@northstarvp.com. Again, I'm Julien Meyer, Managing Director here at NorthStar Venture Partners, and I'll be back with you next week for another video. Take care.